Imagine families delay buying cars while companies delay hiring. One cautious decision becomes many cautious decisions. Customer caution reduces sales. Weaker sales reduce business orders, and lower orders can lead to shorter shifts or hiring freezes. When a factory slows production, nearby shops may lose lunch customers and suppliers may receive fewer orders. A recession is a feedback loop, not just a bad number on a news chart. Daily version. A worker keeps savings instead of upgrading appliances. Fear can reduce demand. The cause is not mysterious. A drop in demand can move from stores to employers and then back to households. The early clue is usually not one dramatic collapse. It is canceled orders, delayed hiring, and households becoming cautious together. The pressure shows up when a worker keeps savings instead of upgrading appliances. Business sales fall matters because lower customer spending leaves firms with excess stock and weaker revenue. Real case. A furniture store sees fewer orders and cancels expansion. Sales data changes management behavior. The pressure comes from spending cuts, layoffs, confidence, credit, and demand. Missing that link makes the outcome look random. Companies often freeze vacancies before layoffs begin. Case. Open roles disappear and overtime is cut. Labor markets cool in stages. The main force is clear. Weaker spending can become weaker revenue, weaker hiring, and even weaker confidence. The link becomes clear when open roles disappear and overtime is cut. It shows why recessions are feedback loops between spending, income, hiring, credit, and confidence. Layoffs reduce demand further. Lost wages mean less spending, which hurts other businesses. Daily version. A laid-off worker cancels travel and restaurants lose revenue. Income shocks spread through communities. Use the observable clues. Watch orders, hiring, credit conditions, overtime, inventories, and local customer traffic together. Imagine a small business cannot renew a loan on easy terms connects the private choice to the visible outcome. Less credit means less investment. A familiar case is a small business cannot renew a loan on easy terms. Interest rates can trigger cooling. Higher borrowing costs can reduce homes, cars, and business projects. Seen when a mortgage payment jumps enough to stop a purchase. Debt-funded demand is sensitive. What makes the issue practical is hiring trends, credit conditions, and customer traffic, not memorizing terminology. Asset prices can fall. Stocks or property declines reduce wealth and confidence. Paper losses can change real spending. A small correction at this point can prevent a more painful adjustment later. Inventories tell a story. Unsold goods show demand was overestimated. Seen when warehouses fill with products bought for last year. A Euro's optimism. Production slows to clear inventory. Delay can turn a manageable choice into a more expensive one. Exports, energy prices, or supply interruptions can push economies down. Common case. A factory loses foreign orders and cuts shifts. Modern economies are linked. For a family, the practical response is to watch income security, debt payments, and emergency cash before making large commitments. A real-life version is a factory loses foreign orders and cuts shifts. Not every slowdown is recession. Economies can pause without broad contraction. In practice, one weak sector does not always pull down the whole country. Breadth and duration matter. The central link is simple. Customer caution can reduce sales, hiring, income, and then spending again. Stimulus, unemployment benefits, and public spending try to support demand. Think of cash support helps households keep paying bills. Policy tries to stop the feedback loop. The topic becomes concrete when cash support helps households keep paying bills. It shows why recessions are feedback loops between spending, income, hiring, credit, and confidence. The small detail to notice is shorter shifts, especially when canceled orders is happening at the same time. Rate cuts can make borrowing cheaper if inflation allows. Concrete case. Lower rates may revive mortgages and business loans. Monetary policy works with delay. The mechanism is direct. A drop in demand can move from stores to employers and then back to households. When lower rates may revive mortgages and business loans, weaker spending can become weaker revenue, weaker hiring, and even weaker confidence. When canceled orders changes, people often adjust around it before they fully understand why they feel pressure. Cyclical industries usually hurt more than essential services. Think of construction may slow while healthcare keeps hiring. Risk depends on sector and debt. The cost becomes visible when construction may slow while healthcare keeps hiring. An early response works better when it is aimed at credit tightening rather than a vague feeling that something is wrong. Households prepare with buffers. Emergency savings and lower debt reduce panic decisions. Think of 3 months of expenses can protect choices during job uncertainty. Resilience is built before shocks. The risk becomes real when 3 months of expenses can protect choices during job uncertainty. One concrete marker is inventory buildup. It shows whether the issue is already shaping behavior rather than staying theoretical. Businesses watch cash flow. Profits can look fine until receivables slow and debt payments continue. Liquidity matters in downturns. For a business, shrinking customer traffic matters more than headlines because it shows whether demand is weakening nearby. The cycle becomes clearer when layoffs, credit tightening, and falling confidence are read as connected parts of the same slowdown. A recession gathers strength when cautious households and cautious companies reinforce each other. Less spending weakens sales, and weaker sales make companies more cautious again. Recoveries start quietly. Orders stabilize, layoffs slow, and confidence returns before headlines improve. Turning points are gradual. The simplest check is hiring trends, credit conditions, and customer traffic, because it replaces guessing with something observable. The real engine is this. Customer caution can reduce sales, hiring, income, and then spending again. The cost becomes visible when a manufacturer adds weekend shifts before GDP looks strong. A recession can begin quietly because businesses often cut overtime and hiring before they announce layoffs. A recession is a chain reaction, not only a frightening headline. Spending slows, businesses protect cash, jobs become less secure, and confidence weakens further. Understanding that sequence helps people prepare calmly. Reduce fragile debt, keep cash flexible, and avoid assuming yesterday a euro's income conditions will last forever. In practice, the danger is the chain reaction, not one bad number. Recessions usually spread through links. Customers spend less, businesses order less, workers lose hours, lenders become cautious, and confidence weakens. The first signs can be ordinary, such as shorter shifts, fewer restaurant bookings, slower construction orders, and inventory staying on shelves. A recession is not one bad headline. It is a chain reaction. Sales weaken, firms cut back, workers worry, banks tighten, and spending falls again. A factory may reduce production first, then nearby shops lose lunch customers, suppliers receive fewer orders, and local hiring slows. That is why recessions often feel confusing at the start. The early signs may appear in shorter shifts, delayed purchases, fuller inventories, and small businesses noticing that regular customers have become more careful. The early signs are often ordinary: fewer orders, shorter shifts, delayed hiring, full inventories, cautious customers, and local businesses feeling a slowdown before the national label arrives. Falling demand weakens revenue, weaker revenue cools hiring, lower income reduces spending, and fear can keep the loop moving even after the first shock has passed. By the time the word recession appears in headlines, many households and small firms may have already felt the slowdown locally.